Back at the height of the early 2000s, Cisco was probably one of the most hyped stocks that everybody just had to have. A little bit on the company, we got Cisco Systems Incorporated, designs, manufactures, and sells internet protocol-based networking and other products related to the communication and information technology industries in the Americas, Europe, the Middle East, Africa, the Asia Pacific, Japan, and China. It provides infrastructure platforms, including networking technologies of switching, routing, wireless, and data centers products that are designed to work together to deliver networking capabilities and transporting and/or store data. The company also offers collaboration product comprising unified communications, Cisco Telepreference, and conferencing, as well as the Internet of Things and analytics softwares. In addition, it provides security products such as network security, cloud and email security, identity and access management, advanced threat protection, and unified threat management products. Further, the company offers a range of service and support options for its customers, including technical support and advanced services. It serves business of various sizes, public institutions, governments, and service providers. The company sells its product services directly as well as through system integrators, service providers, other resellers, and distributors. With a current price of $56.82, does this company's fundamentals match this ticker price? We're going to find out. Hi there, everybody. Welcome to another stock analysis video. We're going to be doing today Cisco, and I really would like to point out that intro because Cisco was one of those companies that in the early 2000s, it soared to nearly $80 a share because it was tech, it was new, anything that had to do with the internet, it just had to be hyped up. And because of that, well, it just completely collapsed after the dot-com bubble popped. And 21 years later, it is still not up to the price that it was prior to the collapse of the 2000s. Normally, I like to show this specific stock when people say that a certain other stock won't be able to fall $100+ because it just won't happen. I usually like to show this one and Intel, but this just goes to show that stocks do fall and their price does come down to match the fundamentals at the end of the day. So this is just an example of that. Starting with the analysis, however, let's start with a dividend summary. This company pays out a dividend yield of 2.6%, which is about 37 cents a share for an annual payout of $1.48. Payout ratio in relationship to the net income is about 43.13%. 5-year growth rate of 8.23%, and they have grown and increased this dividend for 10 consecutive years. Ex-dividend date October 4th, payout date October 27th, and they pay their dividends quarterly. Coming over here to the calculator, we got the ticker symbol CSCO, $56.82, PE of 22.73, so a little bit above what we normally want of anything under than 20, with a market cap of $239.6 billion. Now coming over here to the growth assumption, I am going to say a 5% growth assumption is somewhat adequate. Seeking Alpha, on the other hand, actually has a revenue growth of 1.05%. So the fact that Cisco has a lot of competition, especially now in 2021. I don't think 1% is fair enough. I think these guys are still bringing in money. I think these guys are still bringing in cash flow. So I'm going to say around 5% should be like the lowest I'm going to go for. So if you find that this assumption and my required rate of return of 8.5% is not correct, well, I actually made this calculator available for anybody to use. If you go to my video of my discounted free cash flow calculator where I show how to actually use it, you can actually find the spreadsheet link down in the description. There you can pretty much just change all the assumptions, the growth assumption and the required rate of return to your liking. So all I ask in return for that is please like and subscribe and comment. I would like to grow my channel, and you know, I am planning on putting out more calculators in the future, and if I see that a lot of people like this kind of content, well, I will be more inclined to do it more often. So let's get started now with the fundamentals. Coming over here, we got the net income 2016 9.6 billion to 2020 of 10.6 billion. That is an increase of 11%. I do have to point out the big elephant in the room, and that is that in 2017 they only made a net income of $110 million, which is pretty concerning. Not gonna lie, I have no idea why this happened, and this is definitely something that I highly suggest if you're interested in this company definitely to look at, because this is very, very concerning. This is not something, it's such a big outlier. It's definitely concerning to see. Next, we got the free cash flow, 12.9 billion to 14.8 billion. That's an increase of 13%. Average 5-year free cash flow of $14 billion. Very, very good to see. Somewhat flat, honestly. I mean, the trend line is slightly going down, especially with the projections. But then again, this also has to do with the fact that the projections are based off of the free cash flow to equity divided by the net income. And again, because of this $110 million, it really does skew the number. So I'm technically omitting this 2017 year entirely. Next, we got the revenue. We got $48 billion to $49.8 billion. That is an increase of 3.64%. Somewhat flat, honestly. It's not as much as you would want it to be, but it's an increase nonetheless. Next, we got the total debt. And this is something that obviously we would like it to be decreasing, because a company with less debt, if things were to hit the fan, then if it has less debt, then it would have a less chance of them going bankrupt, and then, well, then everybody's just screwed at that point. But here we got 33.7 billion to 12.7 billion. That is a decrease in their total debt of 166%, which is actually really surprising to see and really, really reassuring. Next, we got the shares outstanding. Again, one of the silent killers of investing. People tend to overlook this. You want this to be decreasing, mainly because if they are issuing more shares, they are diluting you as the investor. Buying back shares, they are giving you a bigger piece of the pie. But we got 4.9 billion to 4.2 billion. That is a decrease in their total shares of 18.16%. And lastly, we got the cash and equivalents, and as of 2021, they have $9.2 billion in cash and equivalents, and their average cash and equivalents is about $10.4 billion. And with all of those metrics, we get the target share price of $50.91. Adjusting for debt, however, this actually comes down to $45.93 with a margin of safety of 5, 10, and 15%. We would ideally like to buy this at $43.63, $41.34, and $39.04. Seeing that the PE is 22.73, and we would like to buy this at anything under 20, seeing that $45 is the target share price after that tells me that my numbers are in the correct ballpark. Now, coming over here to the free cash flow metrics, I would just like to point something out. We got 2017 net income of $110 million. By having this number here completely messed up the free cash flow to equity divided by net income. In fact, let me just show all of you what would happen if I were to include this free cash flow to equity divided by net income in 2017. This actually makes the average percent of free cash flow to equity over net income at 2,439%, which is just completely insane. And the reason for this is because, well, their cash flow that year was 12.8 billion, where they only made a net income of 110 million. This is the reason why having this just completely skewed over the numbers. And from what you can see right here, having that number in there brings up the target share price to $932. That is completely off the charts, and that's not correct. It's definitely an outlier, and that's the reason why I essentially just took it out from the calculations. So if you are using this calculator and you are looking at Cisco, just make sure that in 2017 you take a look at that outlier and essentially omit it from the calculations, because it's just going to skew everything off. Now let's see if they can actually even afford this annual dividends per share of $1.48. The amounts paid in dividends every single year turns out to be about $6 billion, and after that is paid off, they're still left with $7.8 billion. This comes out to be a payout ratio in regards to the free cash flow of 44.53%, and normally I personally like to buy this at anything under 60 or less. So it's the fact that it's 44.5, it's really reassuring that they still have a ton of cash left after paying this dividend in regards to the free cash flow. All in all, the fact that Cisco is pretty close to the current share price, I personally would wait a little bit longer just to buy it. Maybe we get a nice crash in the tech sector, maybe this goes down to the $50 mark, or maybe your assumptions are a little bit higher than mine. I don't necessarily know, and if they are, well, make sure to the discounted free cash flow video, get this calculator. It's free. I have the spreadsheet link in the description. All I ask is for please subscribe, like, and comment. It really does help, and I just really want to just grow my channel. With that said, that pretty much does it for this episode. Like, subscribe, comment. It really does help here with the algorithm. On YouTube, you can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where you will get these videos, my crypto videos, and only on those sites you will also get exclusives as well. Alright, so with that said, peace out and be on the lookout for the next stock analysis video.